Landlords are unhappy in this town because they've been vilified. There's been several strikes against them, so to speak, over the last 6 years. And, we're not a very empathetic bunch. I just don't think there's any support for real estate owners in general in this town.
We need policy that really will make the city more affordable. If our politicians really, truly wanted New York City to be more affordable for everybody, we would have a tax abatement program for new construction that looks more like 421A than 485X. We would have folks wanting new supply in their districts, even if it was going to bring in voters that don't know them and might not vote for them.
All right, gentlemen, I wanted to sit down and discuss New York City housing. So I feel like I've brought together the top broker, Bob Knakal, and the top buyer, Peter Hungerford. Peter, I'm going to go to you first. Why are New York City housing owners so unhappy today?
So I think landlords are unhappy in this town because, they've been vilified. There's been several strikes against them, so to speak, over the last, call it 6 years. And, we're not a very empathetic bunch. And I just don't think there's any support for real estate owners in general in this town, which ultimately, if you think about the tax base in New York and the percentage of taxes that fund New York City and New York City government, it's a huge percentage that comes from property taxes and real estate transactions in general. I think it's something like 60%, maybe more. I don't know if that's
it's about 54% actually.
Okay, 54.
If you add real estate taxes, mortgage recording taxes, transfer taxes, and other charges and fees, real estate contributes 54% to the city budget.
So, and despite that, we just get vilified and have been beaten up by several economic matters over the last 6 years. So I think that's biggest list of reasons.
And we'll dive into some of those in more detail. But Bob, I want to just fire one over to you as well first. It seems like it's got so bad that you've even shifted focus on your business. You're not even talking too much about existing housing stock and focusing more on new development and how housing can be built for the future.
Yeah, well, Brian, let's call it how it really is. I mean, politicians say they want New York to be more affordable for everybody. They say they care about tenants. They don't really care about affordability, and they don't really care about the tenants. They care about getting reelected. And so it's a very target-rich base of voters that are in these rent-stabilized and rent-regulated housing units. And that's what it's all about. If the politicians really cared about affordability, they would do something to create more supply. The solution to all of New York City's housing woes are on the supply side. Just look no further than the pandemic when vacancy soared. Rents in Manhattan dropped 30%. There hasn't been a housing policy implemented anywhere in the United States that's seen rents go down by 5%. We had rents drop by 30%. Why aren't they creating more supply? Because, and they don't want more supply because more supply brings people into their districts that don't know them, might not vote for them, so they don't want new supply. So they're all a bunch of hypocrites that say, we want New York City to be more affordable, yet, but we're not going to do anything except try to protect rent-regulated tenants because that's a very target-rich voter base. So it's not about housing, it's not about the tenants, it's not about affordability, it's all about getting votes. Let's call it how we see it, and let's have these politicians finally do something that's right for the city, not right for them to get reelected.
Let's just stay on New York City because I feel like that's the most pressing topic. So Peter, when you and I last spoke, a lot of your investment thesis was based around something's got to change, that the city was heading for, if not already in, insolvency. How do you feel about it today?
Same thesis. I've doubled down on that thesis. I think we are in an entirely unsustainable system right now, between interest rates and property taxes and insurance and 2019 rent laws. These are all just squeezing all landlords further and further and further and further. And it's unsustainable. New York City is not in a position as a government entity to take over all private housing. And the banks are, really beginning to foreclose and feel the pain. Foreclosures are through the roof. Bankruptcies are through the roof. It's just going to continue if nothing within that unsustainable system changes. And, for us, we have a very long runway because we were fortunate enough to have today's basis. If you're unfortunate enough to have purchased, something between 2012 and 2022, or you just simply levered up over that period of time when interest rates were lower, we're buying debt at, 40 and 50% discounts right now on more of this kind of product. Because
which is interesting because at a 40, 50% discount on the debt, that's 50% of the value. So you're talking about buying property for 25 or 30 cents on the dollar.
Yes, in some instances, for sure. Relative to 2018, 2019 pricing and debt levels.
If you've been wondering what types of deals we've been working on,
we made it easy for you. Just click on the link, show notes below.
we're talking real deals and real opportunities.
Whether you're an investor or owner or just curious to know what's going on behind the scenes.
Just click the link below and it'll bring you right to all of our available inventory. And I think we need to preface this conversation that we all love New York, but sometimes to me, it just feels like New York City cannot get out of its own way. Peter mentioned 2019 HSTPA. In 2022, 421A expired. They let it expire. In 2024, they bought out 485X, a really watered down version that really hasn't caught fire yet. And now in 2025, it looks like the Democratic nominee is a socialist, an actual socialist, not just something we're saying is a socialist. So when you think about all of that, we love New York despite all these challenges. Do you think that New York City can be saved, Bob?
I think it absolutely can. Don't forget the political pendulum historically shifts over time. I would say that pendulum is heavier now than it's ever been in my career. I've been doing this 41 years now, and
That's an impactful statement.
It is a very, very heavy pendulum. But look, things were so bad during the Dinkins administration that it created an opportunity for someone like Giuliani to get elected. And it could be that the silver lining, if our socialist/communist nominee gets elected, that things might get bad enough that the pendulum will swing. Something has to be done to make that pendulum swing. But if you think about it, we're in an environment with housing where price controls are creating scarcity. Public policy is creating scarcity. When you have a real estate market that functions with a higher correlation to public policy than supply and demand, you got problems. And price controls lead to scarcity. We have scarcity in housing. Why is it that in new construction apartments today, rents in Manhattan are now over $150 a square foot? How do you afford paying $150 a square foot? Well, you do that because supply is so constrained that you have to bid up. The few things that are remaining are priced extraordinarily high. And to the extent that a rent freeze kicks in for 4 years, which is what Mamdani has pledged, that's kind of the third nail in the coffin for rent-regulated housing in the short term. I agree with Peter's thesis that it is a great time to buy only because you're buying buildings at less than land value. Forget about less than replacement cost. This is less than land value, a lot of these buildings. So I think inherently that is a good basis, and things have to change because they're not sustainable. So I agree with Peter's thesis completely, but I think there's still a lot more short-term pain to go through. But we need policy that really will make the city more affordable. If our politicians really, truly wanted New York City to be more affordable for everybody, we would have a tax abatement program for new construction that looks more like 421A than 485X. We would have folks wanting new supply in their districts, even if it was going to bring in voters that don't know them and might not vote for them. We would have an MCI and IAI program. Look, that program was probably, those two programs, probably the most effective housing programs the city has ever implemented. In 1978, the dilapidation rate in New York City's housing stock was 14%. So 14% of the housing units were deemed uninhabitable because they were in such bad shape. So the MCI program and the IAI program come along, incentivize the private sector to dump tens of billions of dollars into the housing stock. So in 2019, the dilapidation rate in New York City was 0.04%. Great for everybody. Great for tenants, great for quality of life, living conditions, everything. And HSTPA neutered both of those programs. So now the buildings are deteriorating. There's no incentive to invest capital in the buildings. And it's creating worse conditions for tenants. So if you really want New York to be more affordable, create more supply, bring back the MCI and the IAI the way it used to be to get the private sector investing in the housing stock again. I mean, these are no-brainers. The only reason that you wouldn't possibly want that to happen is because you're afraid you won't get as many votes by not protecting the million people that live in rent-stabilized housing, which is a very energized voter base. But look, let's not bullshit anybody. It's all about getting votes. It's not about caring about the tenants or the quality of life or affordability. That's all BS. It's all about votes. The whole thing is about votes.
Well said.
Peter, you're living and breathing this stuff. I mean, you are a landlord. These are your tenants and these are your buildings. What would you add to what Bob just said?
I mean, I think from my perspective, the other thing that causes some sort of legislative paralysis, if you will, is this belief or narrative that by bringing back something like 421A, you're doing a favor for developers and you're helping developers become wealthier. And I think that whole narrative is just so problematic and it drives me bananas. This country was built on capitalism. This country was built by entrepreneurs. This country was built by championing our successful business people across centuries. And so the fact that there is so much rhetoric out there that's anti-successful business people, or no, I don't want to be seen as a politician helping developers to create supply, which in turn helps my voters, is crazy to me.
Yeah, Peter,
It
think
makes no sense.
Think about how stupid this is, right? There's two arguments that I've heard against a robust tax abatement program. One is, well, if we rezone or we have a good tax abatement program, it's just a windfall for the property owner. Second thing is, hey, we're helping the real estate developer. Well, if the real estate developer builds 200 apartments, that's helping maybe 300 or 400 people who now have a place to live.
Right.
And what about the affordable component within that building? And in terms of the property owner getting a windfall, yeah, the property owner's going to get a windfall. But if you don't rezone or you don't have the tax abatement program, the value of the seller's property is not high enough to compel them to sell. They don't sell, nothing gets built.
Yeah.
So is it so bad that a property owner gets a windfall in terms of increased value? They actually then sell and a building gets built, or you create a tax incentive that incentivizes a developer to buy a site and build a building, and the developer makes money, but yet you're impacting hundreds of people in a positive way.
Yeah,
If you really looked at the bigger picture, to think, oh, we can't help anybody that owns real estate is a moronic position to take.
Of course it is. And, what do you think happens when a landlord like us gets a windfall? Like, we're reinvesting in New York City. Even a very small building owner right now that, let's say, could benefit, the value of their building might double if the 2019 rent laws were rolled back or something like that. That might help them retire. They're going to transact, which is going to fill the tax coffers. They're going to take care of their family. They're going to have more money to pass on to their next generation, which probably has some association with New York City. I mean, it's ludicrous that we'd rather vilify than solve problems.
Thanks for listening to the Broker Brunch. We've now brought you a ton of episodes and we hope we're providing a lot of value. If you have any ideas of people you'd like to see on future episodes, please drop it in the comments so we can make it happen. Bob, you mentioned about cycles in New York City. Back after 9/11, you and Paul Massey made a big bet on New York, that the city would come back, that it was gritty and it was strong. You went, you hired accountants, brokers, bankers, you turned them into very successful real estate brokers. That turned your company extremely successful. Would you make that bet today on New York City?
Yeah, you know what, Brian?
He is making that bet. He's making it right now.
That is such a great question. You know, at that time, we were very, very convicted that New York was tough, it's strong, it's going to come back. I still have the perspective that you should never bet against New York. New York is going to come back. I just think if I was making that same position today and in that same position today, I don't think I would have gone as all in as we did. We hired 150 people. We went from 21 to 150 in 2 years. I wouldn't have grown at the same pace because I'm still. Then I was 100% convicted. Today I'm about 85 or 90. Still very, very pro-city, but there are a lot of hurdles to get over in the short term. I think long term, New York is going to be great, but there is a lot. There's a lot of stuff going on today.
How long it takes
that is inexplicable, inexplicable, and because that political pendulum is so heavy. It's going to take a lot to change things.
Okay, this is the perfect place for my prop. Now, I grew up playing baseball. Very serious baseball player. Huge baseball fan to this day. Love the game. And so, you know, Bob coming out with his baseball card, I love it. It's like my favorite business card of all time. And so I've been to Bob's map room a couple times now. And I realized when you schedule this meeting that I don't have a signed baseball card from the legend himself. And so what I've done is I've brought the newest baseball card of Bob Knakal's. And because I love my fellow entrepreneurs, and I love blue or black, Bob.
Well, let's see. We got the white shirt on there. I think we'll do blue.
Because
Match the tie.
I love and I'm proud of my fellow entrepreneurs. And I love seeing what Bob's doing, starting his own company, rebuilding a team from scratch, doubling down on New York City, which I am of the opinion he could not have possibly done if he weren't 100% certain that New York City was coming back. But he does have a couple of years on me and quite a bit of knowledge. So I'll accept his 85% probability as still highly certain. But if you could sign that as Mayor Knakal, that'd be great.
There you go. Yeah, well, people often ask me, and I always say I love my family too much to get into politics. But Peter, here you go. Thank you so much for that. That's
Thank
awesome.
you. It's perfect.
And while we're talking about Bob, I mean, 41 years in the business, you mentioned. Congratulations. That's a stellar run. You are reflecting on those 41 years by going down memory lane on your top 5 deals. Mm-hmm. And when you think about those deals, they are the who's who of New York City real estate. We all even know those addresses. What did they all have in common, all 5 deals, when you think back on it? Thank you for listening to the Broker Brunch. If you enjoy the show, please hit subscribe so we can reach more people.
Well, Brian, I think back on all the transactions, and last week we closed deal 2,353. But it's all about the people. It's about the clients. The things that make the deals memorable are the people that you deal with. And I've had the good fortune to deal with the proverbial little old lady who owns one building, up to Steve Roth, chairman of Vornado, and Steve Ross, the chairman of Related, and the biggest names in the industry, and folks like Peter. And it's the people. The people are what makes us. I always say that we're really not in the real estate business. We're in the information and relationship business. And, you have to know your information. I'm a big proponent of proprietary data, as you know. But the people are the thing that is the coolest. And, my number one deal was a deal that Harry Maclau was the seller of, and Richard and Adam Parkoff were the buyers of. And, just guys who are such big personalities, big characters in the business. And so I think if I look back on everything, the thing that is most memorable are all the great people that are in this business, and they make it fun. And sometimes you want to pull your hair out, and sometimes you want to just give them a hug and a kiss. But either way, it's always interesting and always fun.
What I say in my office all the time is if people don't want to use our real estate is worthless. And that's true whether it's land or apartment buildings or any other kind of real estate. If you don't have people that want to use it, it is worthless. So you better take care of those people.
Bob, when it comes to sales and market volume, you wrote a piece about a year ago in The Observer, and you mentioned that the average building sells 2.6% of buildings sell in a given year. And you predicted that it would go to maybe above 5% in 25 and 26. Where are we in terms of that prediction today?
Yeah, well, I think we're not quite on that pace. And I think a lot of it is that a lot of the transaction volume that we thought would be stimulated by market conditions has slowed down. There's a lot of proverbially kicking the can down the road. Particularly if you think about the market, the overwhelming majority of buildings are multifamily buildings in New York. And interestingly, in many of them, the equity has been completely wiped out. The debt is impaired. The owner would like to hand the keys back to the bank. The bank doesn't want the keys because there are tremendous liabilities associated with owning property. One of the idiosyncrasies of the multifamily market in New York is that if you buy a building or you take title to a building and you own it even for an hour, you are completely responsible for the misdeeds of all the past owners. And in the foreclosure process, some of those liabilities are marginalized, but on a moving forward basis, you become responsible. So the banks don't want any part of the deeds. And you alluded before to the fact that I'm not doing as much multifamily as I used to. And it's basically because you're not selling the building anymore, really. I tell owners all the time, you're selling the boxes of paperwork in your management office is what you're selling. Building could be perfectly clean and in great condition, or it could be in crummy condition and dirty. Doesn't matter. It has no impact on the value. What matters is, can you prove that your leases are legal? Can you prove you deregulated apartments properly? Do you have all the paperwork to support that? Oh, your building went through a sub-rehab in 1983. Do you have all the documentation to prove that happens? Like, I love that character that Denzel Washington played, Alonzo, in Training Day. And he always said, it's not what you know, it's what you can prove. And in the multifamily business in New York, it's not what you know, it's what you can prove.
And that's the perfect segue to talking about the banks, because the banks are a huge part of this, right? Like you said, they don't want it back a lot of the time. So if I'm talking to 100 multifamily owners in a week, I would say more than half would sell if they could, but they can't because they're underwater. Peter, I have so much respect for you and the bravery and the conviction that you're showing in terms of just pushing through. You were given a set of rules that are outside of your control. You're a young man, so you had to make bets. You have to move things forward. And I think that's great to see for as a broker, to see a buyer just being as aggressive as you are. Thousands of units purchased over the last couple of years. I got to imagine getting a bank on board must be like extremely tough.
That's the hardest part. Finding the sellers today is easy. It's getting the bank to behave themselves. And to think like, within this new box of rules and issues and how to get out of that box together. The lenders are driving transactions, whether that be the outgoing lender who needs to take a haircut or, some kind of modification or whatever. And, convincing a new lender to come into this is, maybe even harder. So it's, that's...
Well, think about this. I think the lending environment has to change. And I think the traditional concept of collateral is completely misguided because of what I just said earlier.
Sure.
If I'm the lender, I don't want the building as collateral. I want the boxes of paperwork as collateral in addition to the building. Yeah. There are several people today who are losing buildings and, you know what? The last 5 years of documents seem to have gone missing.
Don't know where they went.
Maybe if you let me off my personal guarantee, maybe I'll be able to find those.
Yep, I'm seeing that move, not just from little guys, but from big guys
The buildings are worth significantly less if you don't have the paperwork. If I'm a lender, I want, moving forward, I want, at the time I make the loan, I want all the historical files. And moving forward, I want a copy of every lease. I want a copy of every renovation invoice and proof of payment of every. As a lender, I'm going to have to charge more for these loans because my administration costs are going to go way up because I need to verify that what my borrower is doing to the collateral is in my interest to preserve my collateral value.
You're right. That is what banks should be doing. You are 100% correct about that.
Yeah, I wrote a letter to Jamie Dimon about this because Chase is one of the biggest lenders in the space. I said, you have the building as collateral. Why would you take something that's valueless?
Yep.
You got to get the paperwork and the support. And that means banks have to beef up their departments to administrate the underlying assets because the brick and mortar is not really the collateral.
Now, fortunately for the JP Morgan Chases of the world, though, that would only be necessary in New York City and maybe, to a lesser extent, New York State. They can still lend in other states all they want freely and not have to look at the world this way. So this is really just a function of the ridiculous New York State and New York City laws if a bank wants to lend in this town.
It almost feels like the bank and the borrower, the owner, need to link arms and jump off the cliff together in order to get a deal done today.
Yes.
How do you facilitate that as a broker, Bob? You can't even just deal with the owner anymore. I know for me personally, it's who's the bank, what's the note? That's one of my first questions.
Yeah, well, Brian, what we're doing today, I'm handling relatively few multifamily deals, picking and choosing what we work on. But I will not even take a property to market unless the owner has hired someone to take a look at the rents, the boxes of paperwork, and substantiate that the building is what we think the building is. I was marketing a property on the Upper East Side a few years ago when my whole perspective changed. The owner says, hey, I've got 10 units on top of a store and it's all free market. And several months later, we discovered that 5 of the units were actually rent stabilized and he was overcharging them by thousands every month. And the building's not sellable. And so it was a total wasted effort. And since that experience, I won't even start marketing a property until we've had somebody, a third party, analyze all these rents to figure out what's legal, what's not legal, what you might be able to proactively go back and retroactively deal with. But it has devolved into a business that is more about proctologizing the paperwork to understand what the asset really is, as opposed to selling real estate. And that's why I'm doing mostly today, I'm doing ground up development and redevelopment stuff.
Smart. Now, I will point out, though, those statements are all true where there are buildings with allegedly free market units in them that were built, pre-1969 or whatever. When you buy buildings that are 100% rent stabilized and the rents, have been registered properly, just the registration. In that instance, I need to do far less lease review because, it's you don't have the overcharge
but
noise.
to the extent you got vacancy increases or
Sure.
you did renovations,
No, still
the rents.
definitely meaningful analysis, but
The bank business, so as a broker, the bank business, I feel like is almost the holy grail of the business that I would want to get. There's no emotion involved. They're going to sell. They need to get it off their books. As a broker, what you want is motivation. So working within that time frame for a bank must be amazing. Bob, you're someone who has seen this for the last 41 years. How do you win that bank business and how do you become the bank's broker?
Yeah, it's hard. It's like anything. You just have to reach out, build the relationships, and be there. But what I will say is that the involvement of banks comes cyclically as the markets change. So, and it's changed very profoundly over the years. I remember back during the S&L crisis in the early 90s, it was the best. Many banks went belly up. The RTC was formed. The banks took a long time to go through a 2 or 3 year foreclosure process, but they took title to the properties, hired brokers to sell them. That was awesome business, an awesome time. The recessions that took place in the early 2000s and again, 08, 09, banks didn't want to go through that 2 or 3 year foreclosure process. So they hired brokers to sell paper. And that was also a great business. This time around, the banks they've been less overt about how they're dealing with their problems, mainly because I think they don't want anyone looking under the hood too closely. I think there's a lot of fundamental problems in the banking system, and I think it really epitomized by the way the Signature loan portfolio was sold, which it really wasn't sold. A servicing contract on the loans was sold, because I think the FDIC was concerned that if that paper sold at what it really would have been marked down to, it would have created an avalanche of bank failures, because the paper is really worth a lot less than lenders are marking it to. So I think, when the recent disruptions happened, we had been selling a few loans for banks, and they immediately pulled them off the market when Signature went down. They were immediately taken off the market, and I think the lenders were like, "Hey, we don't want anybody looking too closely at what we have on our books because it's not pretty."
For a guy who's not working on much housing these days, you sure sound smart.
Look, I just call it how I see it.
A fan of the game. But you're both world-class deal makers, so I'd be remiss not to hit on some deal making here while I have you both together. With the lack of discretionary sellers in the market today, Peter, how do you decide what deals to focus on?
Seller profile and sort of like the reason a seller has to sell right now is more important to me than just about anything else. Because in this market environment, and this might just be specific to my asset class, I don't pretend to know anything about development sites or office buildings or other asset classes. But for my asset class, especially in this town, right now, if you don't have a really good reason to sell, I just don't believe you that you're going to sell at today's pricing, because today's pricing is ugly. You're not selling unless you have to, unless you have some exogenous reason or demand to sell.
What is that reason?
I mean, it could be a lender's forcing you to sell, but in which case you typically need cooperation from the lender, and then you've got a two-headed seller, it could be the expiration of a particular investment fund. One of the portfolio, actually both of the portfolios, large portfolios that we've purchased in the last 12 to 18 months have been that, where there's a limited partner involved, or an expiration of a fund that is forcing the sale and meeting the market wherever it is, whatever that means, by any means necessary. If that doesn't describe you as a seller right now, I'm not really interested, because you're not going to meet today's market where it is.
So that certainty of close is something that is front and center in your head before you even lift a pen on a deal.
I wouldn't describe it as certainty of closing. I would describe it as certainty of desire. The seller needs to have
Motivation.
a real motivation, because it is not easy to transact today at all. And I don't have as much historical perspective on that as Bob does, but I think you would echo that general sentiment that, man, it's tough to complete a transaction in today's environment, whether that's because of the outgoing bank or the incoming bank or just the noise around this asset class in general.
I think that's a really good point from a buyer's perspective. And Bob, I mean, you've been brokering deals for 41 years. Is it a different conversation with some of the owners that you might know for a couple of decades? Do you say things and I'm like, come on, are you really selling this? Are we really doing this? I'm going to spend time on it with you.
No, we always ask what the motivation is. That's one of the first questions we always ask, is why you're selling. But I think relative to Peter's comments, and I think he was spot on for the rent-regulated housing sector, but one of the things that uniquely illustrates what we're going through in the broader market today is, for the first time, we have different product sectors moving in different directions at the same time. Retail's on the way up, industrial's good, hotels are on fire, Class A new construction office is doing well, B and C office still has its challenges. In the multifamily space, I think you almost have to differentiate between rent-regulated buildings and new construction stuff. The new construction, because rents, there's so much upward pressure on rents because our politicians want to make everything more affordable. Free market rents are skyrocketing. And so there are discretionary sellers in the free market space because these buildings are highly sought after. But, one of the landmines that's out there with good cause eviction is, widely thought that good cause was just getting the camel's nose under the tent, and that the what seems like a pretty high cap on rent increases was just a way to get it passed. And now someone's going to come out and say, hey, it's not fair that rent stabilized tenants aren't treated the same way as free market tenants. It's got to be fair for everybody. Just make it the 1-year rent guidelines board increase for the good cause eviction cap, which is right around the corner. And, so there are some potential landmines on the horizon, but for the time being, there are discretionary sellers in that free market space because the rents have skyrocketed, NOIs are way up, and surprisingly, I think cap rates are surprisingly low in that sector. Peter was mentioning he did a deal at an 8 cap recently. I mean, that's like stuff you saw in the mid 80s. But in that free market space, you still can get cap rates down in the 5s, which is, a very low cap by today's standards, even though the same buildings would have sold for a 3 cap 10 years ago.
We're back. Another season of the Broker Brunch podcast. Summertime in New York. We've got a lot of exciting conversations coming up. We hope you enjoy listening.
Seems like the height of hypocrisy that the residents of New York are saying it's unaffordable to live here. And as a result, then our lawmakers go out and make things even more unaffordable by getting involved. Why can they not just see common sense and make decisions accordingly?
It's about votes, Brian. We talked about that.
I tried to move us on from New York. You're pulling us back into the Rent Guidelines Board in New York. Let's talk about the elephant in the room before we wrap. There's an election happening for New York City Mayor in November. If Zoran Mandani gets in, what happens to our industry?
Well, I say 2 thoughts. One, I think the rent-regulated housing market got 1 nail in the coffin with HSTPA, 2nd nail in the coffin with COVID. This could be the 3rd if there's a rent freeze. Really going to create a challenge.
Don't forget about interest rates.
Yeah, notwithstanding, I think long-term, I think this is a great buying opportunity. I think Peter's doing exactly the right thing. Second thing that I think is a more broad comment is that most people erroneously think that cap rates are highly correlated to interest rates. They are not. They are much more highly correlated to the flow of capital. To the extent he gets elected, institutions particularly are going to second think whether they want to deploy capital into New York. If the capital deployment slows down or dries up, that's going to drive cap rates up. And if that happens, that's another very negative thing. What's going to happen with crime? If we have a bunch of social workers out on the street begging people not to create crimes, that's not really going to help.
You don't think free grocery stores are going to help crime?
It's another price control going to lead to scarcity. I mean, look at any of the publicly owned grocery stores in any of the
walk into any CVS
where they have
or
them.
Dwayne Reed in the city. Everything's locked down.
Yeah, so I think, look, again, it's temporary. We've been through all kinds of craziness previously. It's for a set period of time. We'll see what happens. The jury's still out, but don't bet against New York. New York's the greatest place in the world.
Peter, I'll give you the final word on it. Are we at the bottom of the market, or are the best deals still yet to come?
Well, not into calling bottoms, but if I had to guess, I would say we're not at the bottom yet. Especially not if Mamdani gets elected. Mamdani gets elected, there's going to be more carnage, more sellers, more capital flight out of New York City. I've had to field I don't know how many calls since the primaries from partners of mine asking me whether I'm scared now or not. Won't change my bet on New York long term. But as you pointed out, I have a little bit longer to go in my career, and I can make that sort of a long-term bet. It doesn't make sense to me to vote for a socialist mayor of the center of capitalism.
So we're in tough times, but keep the faith. I think that's how I would summarize this conversation. Bob,
like
really,
it.
really appreciate your time. Peter, thanks so much.
Always great to be with you, Brian.
Thanks, Brian.